So everyone, I just want you to know we're about to do a masterclass in M1 Finance. We are going to break this tool down and show you all the features, and this is going to be valuable content. Before I get started, like, comment, subscribe. It just lets me know, lets us know, lets the team know that you want more of this content and gives us the courage to keep fighting the good fight. All right, guys, let's get into it. There's a lot of stuff that they just don't teach you in school, and you kind of have to figure this out on your own. You start to cobble together some answers and you try to come up with a financial game plan for yourself. You do your best, but man, if you knew what the questions were ahead of time, if you knew everything that you were supposed to know, you'd be so well positioned, for the next 10 years, 20 years, 30 years. You knowing this now, instead of just figuring this out much, much later in life, this is $1 million skill set easily. So we're just gonna try and go back to the basics here and just walk you through a framework for investing. Now, clearly, if you have an employer, your employer probably offers a retirement plan. And if you haven't looked into that, if you haven't gotten the match yet, if you haven't set up those retirement accounts, you want to start there. But I had a buddy asking me recently, how do I invest outside of my retirement plan? Like, where do I even begin? And I realized that that's a question a lot of people have. And it took me a while to figure out how I wanted to go about doing that as well. And so I wanted to share with you the tool that I actually use for investing outside of my retirement accounts. And the general name that we have for investing outside of your retirement accounts is taxable accounts. Taxable accounts is a big umbrella term. It includes your, checking account, your savings account. It includes your CDs, if you have any of those, which CD stands for Certificate of Deposit, a little fun fact there. And it also includes your investment accounts. This is just your money, and wherever you choose to put it, hopefully it makes a good return, and that return is taxable. So it's called a taxable account. I want to share with you a robo-advisor that I actually use for my finances called M1 Finance. This is where I do the majority of my investments when it comes to taxable accounts. And so we've actually created a review article series for you at ChooseFI.com/M1. This would be a great place to start if you're just trying to figure out how to use it and what some of the perks of using this service are. But I'm just going to take some time today and go with you and create an account. So if you want to join me on this journey, let's hop right in. M1 Finance. When you go to M1 Finance, you will obviously want to click on Get Started, right? So you're going to go ahead and put in your email and your password. And then you will see a screen that says, Welcome to M1. We will get you started in 3 easy steps. Step 1, create a pie. Step 2, open your account. Step 3, fund your account. So pretty simple. Let's see how it works. On the next screen, it's gonna say, this is a pie. And I wanna explain the concept of a pie just for a second here before we really get into it. Consider all of the money you're investing now and in the future makes up 100% of the pie. How do you wanna allocate that money? If you're early on in your investing timeline, probably the vast majority of the money that you can contribute will go towards equities, towards stocks, owning a percentage of major companies throughout the world. We've talked in other videos that we're huge fans of index funds, and the idea is that we don't necessarily need to pick the winners and the losers. We're gonna buy them all, right? We can do that inside of M1. So let's go ahead and create a pie. So we are gonna go ahead and pick Vanguard's total stock market, and we're also gonna pick Vanguard's total bond market. I say we, meaning this is what I'm doing for this setup, and here's the mindset that I'm using on how I pick it out. Now, honestly, a 2-fund portfolio when you're really just getting started would probably be sufficient. I know many people with a 1-fund portfolio early on in their investing timeline. If you wanted to add some flavor to this, you could add a couple individual companies like maybe Amazon, Apple, Microsoft, Facebook, Netflix, Alphabet, that's Google. These are all pretty well-known, established companies with long-term, outlook. All of these are pretty familiar faces, I would imagine. But you could pick all of them, a few of them, none of them. I don't think you need to own individual companies. I think it's actually higher risk to do that, but here they are. I will just say that to get past this screen, M1 tries to get you, they want you to pick at least 3 investments, 3 funds to get started. And that's because it's really going the opposite direction. They really don't want you to be 100% in on one fund like Facebook or Netflix. They're trying to encourage diversity. So the founder of this company thought it was very important that you have at least 3 things that you pick. I'll be honest with you, if I were gonna go back, I'll just show you the vast majority of my taxable investments go into just a Vanguard total stock market. So I'm going to include bonds in here and a couple other companies just to show you how this pie might be created. but you'll see in a second here when I come back to this screen that the vast majority of what I do is actually just in a Vanguard Total Stock Market Index Fund. So keeping that in mind, what would that might actually look like? So I'm pretty early in my investing timeline. I actually don't hold any bonds in my portfolio currently. I'm 100% equities. Depending on your own specific situation, that may or may not be the right choice for you. Bonds typically have less volatility than stocks. And so if you want to have something in there to smooth the ride, as JL Collins says, then you could throw a few bonds in here as well, a few percentage points of bonds. If you're getting closer to your drawdown, you might want a higher percentage of bonds. It just depends on your ability to weather volatility and maybe more specifically your time horizon before you need the money. The more bonds you have in your portfolio, typically you're reducing your return, right? Because bonds just don't go as quickly as stocks, but it certainly is an option. Let's go ahead and take a look. Our pie needs to total 100%, right? This is 100% of all of our investments. So what do we want to do here? Since we can't go over that, we need to find some percentage points to allocate to these others. So for right now, let's just say that we are, 70% we're 70% in the total stock market. We'll give ourselves maybe 10% in bonds for this initial setup here. We are going to throw the remaining, let's see, actually, we'll make this 20%, right? So we're 20% in bonds, which leaves us about 10%, and we'll split that up between a few of these companies. So there's no like perfect answer here, but we know it needs to total, at the end of the day, all of this has to total 100%. So I know I'm watching a lot of Netflix recently. I don't know if that's a good way to determine what stock you're using, but we're just creating this pie. So here's what we came up with for this asset allocation. We're 70% in stocks, 20% in bonds, and we have a few percentage points delegated between these individual companies, up to 10% of our taxable investments. So we have 70% in the total stock market, 20% in bonds. We have a few percentage points spread out through a few individual companies. Most of these are tech companies, I notice, but that's just the way it rolled out this time. And we're gonna press continue. Now, M1 tells us here's how our money would have done. So if we had invested $10,000 in this pie just 5 years ago, that money would have resulted in a gain of $4,769. You know, what's actually really interesting about that analysis is that I'm recording this in April of 2020. Coronavirus has completely nuked the economy and just things are crazy right now. But this would have done incredibly well. Like that's 5 years ago, you would have had a 50% return on your money. Now, past performance is not in any way indicative of future success, but I think there is a pattern that we see over time that says that time in the market is really, really important. And so we just want to get started. So we're gonna go ahead and press continue. Once we have created our first pie, we then have the option to add a little bit of complexity to our portfolio. Now you need to verify your identity here, so I will go ahead and do that now. Sending me a text message. Let's see if it worked. All right, got my code. Now you're gonna go ahead and put in your information here. Let's see if I can do that. And we're gonna go ahead and put in our date of birth, citizenship status, employment status. That's private information, right? All right, on this screen, I think the SEC actually requires that they do a few of these extra questions. What is your approximate annual income? What is your total net worth? So this could be, you know, do you have equity in your home? What's the total amount in your investment accounts, your retirement accounts? This is a assets compared to liabilities equation. I don't think you need to go refer to your tax returns. There's a pretty big range here, but just pick the best one that applies to you. What is your liquid net worth? Again, this is kind of a loose question, but I would say generally what they're getting at here is how much money do you have in your bank accounts? How much money do you have in your taxable accounts? I think they're probably locking out like your home equity, and they're saying don't include your home equity and don't include your retirement accounts. But money that you could readily access in a relatively short period of time, that's what they're actually looking for here. And then finally, what is your investing experience? Just pick whichever one you feel best describes you. Good experience, limited experience, none. What is your risk tolerance? Well, mine's pretty good. Yeah, how do you feel? What's your risk tolerance? It's interesting, when you don't really have anything invested, you don't really know what your risk tolerance is. When you have money invested and the money goes down by 10 or 15 or 20%, if you're able to sleep like a baby at night, you're not worried about it, then your risk tolerance is pretty good. If you can't go to sleep and you're having anxiety attacks, then it's not as good, right? And so risk tolerance is your perceptional facts on the ground. It's you having a good financial plan in place, but it's also making sure that when the market goes down, which, hear me on this, the market will go down. The market's going down right now. You're not freaking out and selling everything. The big piece of this has to be stay the course. The stock market has never been easier to access, and it's never been easier to build lasting wealth for yourself if you stay the course. But if you panic and sell, if you second guess all your choices, if you're trying to hop in and out, you're going to lose your shirt, and you shouldn't do this. So this is actually a great question. I don't know if I guess the SEC is asking M1 to ask you this, but this is a great time for you to know thyself and understand what your plan is. I don't care what this money does today, tomorrow, the next day. I'm thinking about this in terms of the long term, 5, 10, 15, 40 years. And because of the strategy that we're using, buying the whole market, buying the index, we're going to do really, really well over that period of time. What is your risk tolerance? Mine's pretty high. All right, what is your investment horizon? I think this question is key because if your investment horizon is only a year or two, like you need this money within a year or two, then your risk tolerance actually should be pretty low, right? When you talk about risk tolerance, you have to look at, yes, the anxiety that I mentioned a second ago, but also what is your timeline? If you're in your early 20s or 30s and you're investing for the next 20, 30, 40 years, you have a very long horizon, so you can tolerate a lot more risk in the short term. If you're getting closer to needing this money, you can't afford for it to go down dramatically. So your investment horizon is shorter, therefore your risk tolerance is shorter. That's just a really important concept to understand. And maybe as a consequence of realizing that your investment horizon is shorter, maybe you're gonna have less money in stocks. I'm not saying you're not in stocks at all, but you're gonna have less money in stocks, and you're gonna have a higher percentage of your portfolio dedicated towards other asset classes like bonds. So what is your investment horizon? Short, less than 3 years, average 4 to 7 years, long, 8 years or more. Definitely in my case, I have a long-term horizon for this money, so 8 years or more. Next question, how important is liquidity to you? This is your money. I want to be able to access this money at any time. I don't want to draw it down on it, but it's another place for my money. So I don't know why this question is somewhat important. That's why I'm investing in and this is a great point. Inside of M1, you can actually fund retirement accounts as well as taxable accounts. Today, we're just talking about doing taxable investing. If liquidity was important, you probably wouldn't want to put this inside of a retirement account, right? You'd want to know that you can sell this without a penalty at any time. So for me, liquidity is somewhat important. It's somewhat important. And then how did you hear about us? Well, you heard about it from ChooseFI, right? From Jonathan at ChooseFI. You heard about it from a video. And yeah, to be clear, M1 Finance is an affiliate partner of ChooseFI. So when you do use our affiliate link, you are supporting the show, the platform, at great benefit to yourself and no cost. So yeah, you heard about M1 Finance from a video. What is your social security number? This isn't LifeLock. I'm not putting it out there. Sorry. All right, do any of these apply? Per federal regulations, we are required to ask for these disclosures. For most people, none of these will apply. So I am affiliated with or work for a broker or dealer. Yeah, none of these apply. Read through them. Okay, so there we got all of our information in there. And if everything looks okay, we are going to press okay. Boom, we did it. We've created our account, we've opened our account, and the last step here is funding our account. Man, this is a really big deal. This is you at the doorstep of making your first taxable investment. So you have two options. You can manually enter in your routing number, your account number, or you can do it via Plaid. It basically just depends on how fast you want to get your money in the account. M1 Finance uses the highest levels of security protocol. It's basically a bank-to-bank transfer. But the one, I guess, pro or con would be that if you do the instant connection option there, it's an instant transfer where you could get your money invested in today. Whereas if you do the manual connection where you're manually putting in your routing number and your account number, you might have to wait a couple days to see that money show up in the account, just because they're actually having to set up the connection manually. So hope that helps. All right, you got your bank account linked up, and now we are gonna make our first deposit. So, I feel like there's something big about having that first $1,000 in the bank. We're gonna put $1,000 into this market, and that's interesting. The market is the market's really volatile right now, and there's a chance the market could go down farther. But this is a strong belief that we're in this for the long term, and it's impossible to figure out what the top is and what the bottom is. It's so easy to do it in hindsight, but it's really hard to do it with any actual knowledge ahead of time. So we want to get in the market. So we're going to fund this with $1,000, our first $1,000 in our taxable account. All right, here we are. So you got your home screen now. Transfer completed. All right, so we have our $1,000 is invested in M1. Everyone, this is the first part in a multi-part series on M1. We're breaking this down step by step. Stay tuned with us. We're gonna really show you all the features, how to get full functionality out of this. We're gonna invest $1,000 during this tutorial and show you exactly how to get the pie that matches your risk tolerance to maximize your returns and minimize your risk. For more information, go to ChooseFI.com/M1. Hey, did you get value from the episode? Make sure you like, comment, and subscribe. We crave your feedback. We need your feedback. It keeps us going, and it lets us know what we didn't cover, what we could have covered better. So like, comment, subscribe, ring that bell. It's still there. It just lets YouTube know you want us to send you a notification when we roll out the next update to this video. Thanks, guys. We'll see you next time.